Welcome back to the deep dive. Today we're focusing on a company that didn't just tweak the financial system.
Not at all.
It fundamentally exposed and then replaced this massive inefficiency right at the heart of global commerce. We're going deep on Wise.
Which many people will still know by its original name, TransferWise.
Exactly. And if you, the listener, have ever tried to send money abroad, maybe you're paying a contractor or moving funds for a property.
Or just supporting family overseas.
Right, you have felt that pain. For decades, it felt like this toll road where every single person took a cut and the fees are just, intentionally hidden.
They were completely opaque.
So today, we are unpacking how two founders challenged an industry worth billions, an industry built almost entirely on that lack of clarity.
That feeling of being exploited is, I think, completely central to the Wise story. And when you look at the source material, you realize the real cost wasn't that, visible transfer fee the banks would advertise.
No.
It was the huge hidden margin they tucked away inside the exchange rate itself. Ah, okay. Banks would quote you a rate that was, several percentage points off the actual interbank rate, the mid-market rate, and they just relied on the fact that you couldn't easily check the difference.
So that opacity was their entire profit engine.
It was.
Okay, so our mission today is to really get under the hood here. We want to understand that specific structural flaw Wise identified, the counterintuitive strategy they used, which was radical transparency, and how they went from solving a personal frustration to becoming, as the sources call it, a foundational layer for global financial connectivity.
And it all starts with that personal frustration with the founders themselves in London.
Exactly. This is the part of the story everyone loves because it's so relatable. You have these two Estonian founders.
Christo Kierman and Taavet Henriques.
Right. Christo was at Deloitte, and Taavet was actually the first employee at Skype. So these are tech-savvy guys.
And they're both living these international lives, constantly needing to convert currency. Taavet was paid in euros but lived in the UK, so he needed pounds.
And Christo needed to send pounds back home to an account in Estonia. And they were just constantly losing money to these terrible bank rates.
All the time.
And the genius was in the solution they came up with. It was so simple.
Almost laughably simple.
They just bypassed the banks entirely. Christo would deposit the pounds he needed to send directly into Taavet's UK account.
And then Taavet, who had the euros, would just put the equivalent amount into Christo's account in Estonia.
And they just settled it privately, using the real mid-market rate they found online.
And what's so fascinating there is that this wasn't just, a clever hack between friends.
It was more than that.
It was a structural revelation. It proved the inefficiency wasn't technological. They had smartphones, fast internet. It was entirely systemic.
The system was built to be slow.
Exactly. It was built on intermediaries and complex settlements. They realized transfers could be way faster, way cheaper if you just stopped the money from physically crossing borders in the first place.
So you just match the demand locally.
That was the core insight.
So if the insight was structural, the first big innovation had to be infrastructural.
Yeah.
How did they build the system to actually handle that matching, but at scale?
Well, they created a global network of local bank accounts. So just, imagine Wise holding a bank account in London, another one in Berlin, another in New York.
Okay.
So when you, a customer in the UK, want to send £1,000 to Germany, Wise shows you the mid-market rate. They deduct a small, very transparent fee.
And you just pay into their UK account.
You pay it locally. And this is the critical part. That money never leaves the UK.
It stays put.
Wise then just tells its German bank account to pay out the equivalent euros to your recipient in Germany. They've matched your outbound transfer with, maybe someone else's inbound one.
So the physical movement of money is just gone.
Circumvented.
That's the operational brilliance.
Yeah.
But let's pause for a second, because for the listener who isn't steeped in banking lore, let's explain what they avoided. They sidestepped this slow, expensive, century-old system called correspondent banking. Why was that such a huge bottleneck?
Because that system, which uses legacy tech like Swift messaging, it requires money to travel through this chain of other banks.
Intermediaries.
Exactly. A small bank in London might not have a direct link to a mid-sized bank in, say, Thailand. So the money has to hop. It goes through a big correspondent bank, maybe in New York or Frankfurt.
And every hop costs money.
Every hop takes a slice. It adds delay, it adds risk, and it leads to those opaque fees and transfer times measured in days, not minutes.
So Wise's system was like swapping assets in a closed loop. You eliminate the expense of long-haul flight.
Perfect analogy.
But the real competitive weapon, as the sources detail, was this commitment to just radical honesty.
Yes.
In a world where every bank relied on hiding things, Wise did the exact opposite. They made the mid-market rate the centerpiece. It was public, it was non-negotiable. You only paid one clear, low fee.
And that was profoundly strategic. I mean, yes, the founders believed in fairness, but transparency was the only way to cut through decades of consumer mistrust.
It wasn't just a moral mission then.
No, they didn't just offer a better rate. They explicitly taught the customer how much their own bank was overcharging them. They weaponized that information.
How did they do that?
They openly published the pricing of major legacy banks. They use live data to show you, look, on a £1,000 transfer, you are losing this much money compared to using Wise.
I remember those ads where they would call out the big banks by name.
They were aggressive,
Huh.
and it built this massive base of trust. It positioned Wise as this global fairness platform fighting the status quo.
So what did the incumbents do? Did they just immediately try to lower their rates?
But initially, no, they mostly just dismissed it.
Too small to matter?
Yeah, the thinking was that a big bank couldn't possibly match those fees. They have legacy infrastructure, expensive branches, huge overhead.
And the margin on foreign exchange was just too important to their profits.
It was crucial. To drop that margin would mean a complete overhaul of their business model. And that is so much harder than just building a new app. Wise forced them into a game they couldn't win.
A game of public comparison. That brings us to the next big challenge, though. As they scaled, that simple peer-to-peer matching, it must have hit limits.
It did.
I mean, what if everyone in the UK wants to send money to Spain, but nobody in Spain is sending money back? Whole model stalls. Right.
That's the exact point where Wise matured from a clever startup into a true infrastructure company. They realized pure matching just wasn't scalable.
So what do they do?
They had to build their own proprietary payment infrastructure from the ground up to manage liquidity globally. This let them pre-fund accounts in major corridors so they could execute transfers even when a perfect match wasn't there.
They were using hedging and settlement techniques to keep that mid-market promise.
Exactly. Sophisticated stuff.
But why go through all that expense and complexity? Why not just use third-party financial APIs?
Because every third party introduces a margin or a delay or a point of failure. The whole Wise ethos was maximum efficiency, minimum cost. To guarantee that speed and that low fee, they needed absolute control. And that obsession with operational discipline, that became their real competitive strength.
And that operational focus, it must have gone hand in hand with their biggest hurdle, regulation.
Oh, absolutely.
Yeah.
To scale globally, they deliberately chose to become fully compliant, not operate in some regulatory gray area.
Which seems like a massive undertaking. You're not just dealing with one set of rules.
No, you're dealing with anti-money laundering laws, data protection, financial licensing in, dozens of countries at the same time.
What did that actually entail?
It meant hiring entire compliance teams, integrating sophisticated anti-fraud checks, and spending years, literally years, working with regulators all over the world. It wasn't cheap or fast.
But it created a huge barrier to entry for anyone else.
A massive one. It proved to the world's central banks that Wise was a serious, compliant player. That regulatory stamp of approval is incredibly hard for a new competitor to get quickly.
And that regulatory strength then let them expand beyond simple remittances. We saw the evolution into products that really impact small businesses.
Absolutely. The Wise multi-currency account, that was revolutionary. It lets you hold and convert, over 50 currencies at the mid-market rate?
But the real game changer was getting local bank details, things like a U.S. routing number or a U.K. sort code.
Yes.
Explain why that's so critical for, say, a small design firm in Argentina.
Well, because if they get paid by a U.S. client, that client can just pay them like it's a domestic transfer. In dollars.
So the client pays no international fee.
Exactly.
Right.
And the Argentine firm gets the money instantly and cheaply. They don't get hit with huge SWIFT fees or have their bank give them a terrible conversion rate. It lets small businesses act as if they had a local presence in all these major markets.
It completely streamlined global commerce for them.
It did.
And when you combine that infrastructure with their mission reports and price comparisons, you can see their strategic moat really forming.
It created an impossible choice for the legacy banks. Either cannibalize your most profitable business or just stand by and watch Wise capture this whole generation of customers who demand transparency.
They prove that customer trust, built on honesty, is just a better business model.
A more robust one, for sure.
So let's jump forward to a defining moment. 2021. Wise goes public. They chose a direct listing on the London Stock Exchange and hit a valuation over £8 billion.
Hmm.
Why a direct listing? Why not a traditional IPO?
That decision was just so perfectly consistent with their brand DNA.
Transparency and efficiency.
Exactly. A traditional IPO has huge underwriting fees you pay to investment banks, an expensive roadshow. With a direct listing, they cut those costs and just kept it streamlined. It was a signal.
Of course, it's not a seamless journey. As they grew, what were the biggest speed bumps they hit? Was it just competitors trying to copy them?
Competition is definitely a factor. You have digital banks like Revolut in the space. You see crypto transfers becoming more common. But I'd say the bigger ongoing challenge for Wise is that regulatory complexity we talked about.
It never goes away?
Never. Every time a regulator changes an anti-money laundering rule or adds a new compliance check, it can cause operational delays. And you see this pop up sometimes as public criticism when a transfer gets held up for screening.
Managing that friction at a global scale must be their constant test.
It is.
So, synthesizing the whole impact here. Wise didn't just build a great company. They really did accelerate this global conversation around financial fairness. What's the main fintech lesson a listener should take away from this?
I think the primary lesson is that the best disruptions, the most scalable ones, they come from identifying a structural problem that everyone else just takes for granted.
That moving money must be slow and expensive.
They rejected that assumption. And they proved that to scale, you need regulatory collaboration. You can't just operate outside the rules. And you need this continuous, obsessive operational efficiency. They didn't exploit inefficiencies, they eliminated them.
They forced the big banks to unbundle their pricing and actually compete on the rate, not on how well they could hide it.
Precisely. And Wise's mission is still to build money without borders, instant, transparent, and eventually free.
Eventually free.
Yeah. And that raises a really fascinating question for you to think about. If Wise continues on this path and keeps driving the cost of moving money down toward that eventually free goal, what happens to the legacy banks whose entire business model was built on those inefficiencies?
And, maybe more excitingly, what new models of global commerce, of entrepreneurship, what does that future of low-cost, borderless payments enable for your business or for your personal finances? That, I think, is the real legacy of Wise.